But we'll quickly move on. Karthik Kumar from Axis Mutual Fund is with us. Karthik is a portfolio manager, alternate listed equities. My first off, Karthik, if I can ask you, how do you look at markets today, given that they've seen a decent recovery right through the week, and they're now close to their 52-week highs odd? How do you look at it?
So you're absolutely spot on. The markets are close to the levels that we saw in last year, November, December. But the fact is that there is a lot more downside support now today. Basically, RBI has paused on its rate hikes. Oil prices have come off. Inflation, CPI, WPI, both are showing a persistent downtrend. That coupled with the fact that there is strong growth, be it at a GDP level or at a market level, means that there is strong support to these markets. But at the same time, the uncertainty from a policy uncertainty, especially coming from the West and US Fed in particular, is likely to weigh on the markets because the inflation there still continues to be higher than their targeted range. While the economy is slowing and there are problems in the banking space. So depending on how the central bank deals with these policies, that would have a bearing on our markets from an upside perspective. So I think that in the near term, the market's most likely to be range bound with a strong downside support.
Hi Karthik, this is Shrishti joining in. If we see the Indian market's performance, then we have actually underperformed the global pair since the end of the last year. What repercussions does that have as per you?
The markets coming into 2023 were quite expensive actually. On an absolute basis, we were trading at 22 times price to earnings. We were trading at a significant premium to regional markets and to the US markets. But over the last 3-4 months, given the underperformance, the valuation premium to US has completely come off. The valuation premiums to emerging markets have moderated, and the price to earnings ratio at a market level has also come off to around 18.5, 19 times price to earnings. So this, coupled with the fact that our growth is still superior to regional markets, actually makes it much more lucrative for FII investors, in my opinion, and they might be more open to relooking at our markets given this context. And I think maybe the money flow that we are seeing over the recent period is testament to the fact that the growth remains strong while the valuations have moderated.
Right, Karthik, and we are right in the thick of earnings. In fact, most of the earnings are done. We've also heard commentary from most companies come out. Could you talk to us about what your key observations have been?
Around 60% of the companies have reported, and at a revenue level, the numbers look much better. Where for every company that has disappointed at a revenue level, 2 companies have surprised. But at the earnings level, the numbers are a bit more moderate. Where for every company that is surprised, there is a company that is disappointed. So clearly, top level numbers look much better. At a sector level, what you're seeing is that the bright spots are industrials. Within industrials, cap goods and engineering companies have done really well. Within consumer discretionary space, the auto two-wheelers, auto ancillaries have done very well. Where in both these sectors, more than 50% of the companies have actually beaten their earnings expectations and have shown improving margins. On the downside, though, tech has been a letdown, where most of the companies have actually missed at a top level, have missed at a bottom level, and in fact, they have moderated their guidance and expectation for the next financial year. So those are largely the positives and negatives based on the result season so far.
Karthik, just wanted your take. How has the market behavior been different from the last year from a quant and the fundamental perspective?
So markets last year, surprisingly, our markets in particular did fairly well, given that developed markets were down in mid double digits, right, during the course of the year. And within that, even more surprising aspect was the markets actually rewarded high risk styles. By that I mean stocks with high volatility and high beta did extremely well. Whereas we as a fund house would argue that last year markets overlooked stocks that had good quality, stocks that had good growth characteristics. Those stocks were largely overlooked by the markets. Whereas this year has been the polar opposite of that, where given the uncertainty, policy uncertainty emanating from Western markets and slowing growth there, the markets have refocused where they are penalizing high risk companies. By that I mean high beta and high volatility companies. And in fact, the markets are refocusing on bottom up fundamentals. They're again relooking at companies from a fundamental lens. By that I mean relooking at growth expectations, relooking at quality, and relooking at reasonable valuations. To that extent, market is discerning based on underlying fundamentals, and which is good for a strategy like ours.
Right, Karthik, and for the benefit of our viewers, let me ask you this question as well. Could you give us the key difference between a quant and a fundamental fund, just to help our viewers really distinguish between the two? What are quant funds? How do they work versus fundamental?
Quant funds, especially with our from Axis, is very similar to a fundamental approach in the sense that these are traditional long-only funds with similar return and risk expectations. But the difference is that the stock selection process is completely systematic, wherein it is based on a rules-based process, and the say of the portfolio manager in terms of stock picks or sector picks is quite limited. Second thing is that from a quant perspective, while the philosophy remains similar to a fundamental process, wherein the aim is to take exposure to different styles. In our case, we are focused on making sure that we invest in a portfolio of quality stocks with good growth at reasonable prices. So the philosophy is similar, except that the path and the tools we are taking to achieve that is different. We as quants look at it all from the lens of data and use data from different sources to kind of help make us a decision in terms of allocation to stocks and allocation to sectors. That's the main difference between a fundamental and a quant style.
Okay, but Karthik, in that case, should quant strategies be a part of investors' core or satellite portfolio? What's your view on that?
Quant strategy should be a part of the core portfolio, I would argue, for multiple reasons. One, like in case of traditional strategies, investors need to give quant strategy time and should be disciplined in terms of being invested in that strategy. Second, because the stock picking process is very different, you will get exposure to ideas and themes that you are not likely to find in other portfolios. As a result of which, the portfolio that you get from a quant approach has less overlap and has less correlation to your existing portfolio of funds. So just like you wouldn't recommend an investor putting all their money into one sector and should rather diversify across sectors. Similarly, with investment in funds, I would argue the suggestion should be same, which is one should diversify across different styles of investing, and quant investing should certainly feature as one of the things in their core portfolio.
Right, Karthik, and if I can also delve or ask you into, what kind of data do you use to identify stock opportunities? Is there a particular style, or what's the kind of data set that you really look at?
In today's day and age, there is no scarcity of data, but the real challenge is to find data sources that add value to the investment process. To that extent, data is the new gold or the new oil. And so we look at a whole range of data sources. We go from traditional data source, like we look at historical income statements, balance sheets, cash flow statements, and analyze the trends therein. We also look at price rated data, volume, to see how a stock reacts to a company reacts to different events and what that means at a stock level. And then we also look at forward-looking data, where we gather data from different sources to kind of analyze the growth prospects of the company at a stock level, and also analyze growth prospects of the growth prospects at a sector level. So we look at the whole range of data to kind of get an understanding of a stock from a holistic perspective.
With this, we'll let you go on that. Thank you so much, Karthik, for joining us today on ET Now and helping with your take onto the markets and Indian markets specifically. Thank you so much. Well, let's move on, and in the week gone by,